If you need your portfolio to pay as much income as possible today, while also minimizing the chance of an income cut in the future, today's strategy may be a good fit for you. A couple weeks ago, we talked about Navigator. Last week, we talked about Sequoia. And in today's video, we're going to be talking about our most income-focused strategy, Income Builder. And just like with the first two videos in this series, we're going to start out by talking about what specific needs does Income Builder satisfy. And we'll do that with our three-part framework that we use when we build client portfolios, and that is the security, income, and growth framework. We use this when assessing a client's particular needs, and we also use it when we build our model portfolios. And the focus for Income Builder is, as the name suggests, for income. That's the number one objective. At the time of this video, the model portfolio for Income Builder had a weighted dividend yield of 3.66%. But while income is the number one objective, not far behind it is security. We've specifically designed Income Builder to focus on companies where this dividend income is not just generous today, but is also sustainable. There is a higher dividend yielding portfolio available out there, but a high dividend yield can sometimes mean that dividend is unsustainable, or the company may be paying out more than it's able to and sacrificing on growing the business. So we want to marry income with security, focusing on things like sector diversification. There are a couple sectors that have traditionally been associated with higher dividend yields, such as utilities, energy, and real estate. Income Builder is designed to have exposure to a lot of different sectors, again, trying to reduce the risk of the portfolio while still maximizing income to the greatest extent possible. In Income Builder, we also do an in-depth financial analysis before buying and while holding companies just to assess their cash flow position. So we look at cash flow, we look at dividend payout ratio, we'll look at debt load, all with the goal of securing this generous income cash flow. And lastly, we focus on growth. The stated goal for Income Builder is to grow the income of the portfolio at the pace of inflation. So for clients who are relying on the cash flows to support their ongoing retirement expenses, those expenses naturally will increase as well. So we seek to have the portfolio's income grow at least enough to keep pace with those bills. If we look at the current Income Builder portfolio, the weighted dividend growth rate over the last 1 year was 4.2%. So that higher dividend yield certainly has a trade-off of accepting a lower dividend growth rate than we get with some of our other strategies, which we'll talk about in later videos. Now let's talk a little bit about the details of how Income Builder actually goes about meeting those needs. Rather than getting into the philosophy of how we make decisions in Income Builder, we thought it would be helpful just to illustrate with a couple of real examples. These are the last trades we made in the Income Builder model. And just before we get into these, at DCM we manage models, not funds or ETFs, which means that each client portfolio is unique. And so in some cases, your portfolio may not perfectly represent the model. Perhaps you have an outlier position in a stock that has a high unrealized capital gain, or a cash hold, or something that causes your portfolio to be a little bit different than what the model is. So just keep that in mind anytime we talk about model changes. This isn't necessarily reflective in all accounts that are in Income Builder. We manage the model, and then the individual clients get trades based on both the model and their specific situation. But anyways, on May 8th, we made some model changes in Income Builder. First, we bought Paychex, which is the specific stock we're going to talk about in this example, give you a little bit more details on why we bought that stock and some of the tools that we use to look at it and others. But to stay fair and balanced, and also to illustrate the point that sometimes Income Builder can have dividend cuts, as with any dividend strategy, we also sold Whirlpool, which we owned, and it did have a dividend cut. A lot of this was tariff related, and also they cited extremely weak demand amid record low consumer sentiment. But we bought Realty Income, which at that time had a dividend yield of 5.24%, a 75% payout ratio relative to funds from operations, which is a profitability metric for REITs in particular. We also sold Valero, and one of the reasons for that is that its dividend yield had fallen below 2%. So when a stock price rises faster than the dividend increases, that means the dividend yield is falling lower. So one of the disciplines for Income Builder is to sell a stock whenever it gets to a low yield and replace that with a higher yielding position. A lot of times we'll use this 2% yield not as a rule, but just as a rule of thumb for us to take a look at a company and see whether it is a good candidate to either trim or sell. And speaking of trim, we did trim Cisco. Unfortunately, if you look at the stock price since May 8th, it's continued to do exceptionally well. But at the time, we felt like it would be prudent to trim Cisco back. Its dividend yield, just like Valero, had fallen. So we wanted to move that dividend from a lower yielding position to a higher yielding position on the left. So let's talk a little bit more detail about one of these stocks in particular. We're going to look at Paychex. This is a screenshot from our DCM IQ internal research tool. We call this the dividend staircase. This shows us what a company's dividend has done over the last 10 years, as represented by this blue line. So when this steps up, that means the company increased their dividend, which you'll see in these bumps. The red line represents the stock price. Finally, in the top right corner, we have the annualized dividend growth rate for the company. For Paychex, you'll notice that the dividend line and the price line have generally grown together over time, but in recent months, the stock price has fallen significantly. Meanwhile, the dividend has continued to be increased, with the last dividend increase at about 10%. So we believe this represents a dislocation and an opportunity to find value in a company that's continued to increase its dividend, but the stock price is down. And as a result of that, Paychex's dividend yield reached over 5%, which is when we took a position. And we believe that represented an excellent value relative to its dividend yield history. This is another tool on our DCM IQ. We call this the dividend yield channel. And this plots the dividend yield of the company by month going back 10 years. The blue line represents the dividend yield, which is simply dividend divided by price. So ideally, we like to buy companies that have higher dividend yields, all else being equal. And one of the ways that we evaluate whether a company's dividend yield is attractive or not is to look at it in relation to its past history. The blue line here represents the dividend yield at each month going back 10 years. So for example, here in 2017, the dividend yield for Paychex was right around 3.4%. The lowest it's been over this 10-year period was back in 2021 to early 2022 when the dividend yield got down to 1.93% at the low. At the other extreme, earlier in 2026, the dividend yield reached 4.81% at the high. When we purchased it, the yield was actually over 5%. This data is shown at the end of months, which is why we have that discrepancy. Intra-month yields can go higher or lower than indicated here. So in general, we would consider dividend yields closer to their all-time lows as being opportunities to trim or sell. And whenever the dividend yield gets near historic highs, which it did earlier this year, we would consider that a potential buying opportunity. Of course, there are other factors that go into this analysis. Sometimes a company will increase its dividend payout ratio, meaning it's going from maybe a 25% payout to a 75% payout. So that will naturally increase their dividend yield without necessarily indicating great value. So there is some nuance to this. Of course, sometimes a business goes through actual long-term fundamental decay, and there's a reason the yield is high, and we still would stay away from it, even at those higher yields relative to history. So there's still a lot of analysis that goes into that, but just simply, this is the underlying logic behind the strategy. Try to find yields when they're at their highs or seem to have opportunities while still having the potential to see dividend growth at the strategy level that at least keeps up with inflation. If you're interested in getting more income from your portfolio, Income Builder could be a good fit for you. If you're interested in learning more about Income Builder or any of our other strategies, I'll put a link in the description down below. If you click on that and fill out the Contact Us form, if you fill out that form, one of our advisors will give you a call and talk about your specific situation and whether DCM may be a good fit for you and your financial needs. Thanks for watching the video, and we'll see you in the next one.